All right, let's dive into something that is quietly, but fundamentally, rewriting the rules of global finance. We're not talking about those crazy, speculative tokens you hear about all the time. No, this is about a whole new kind of digital money that's already changing the world from the inside out.
I want to start with just one number, $1.5 trillion. That's what the market for stablecoins is projected to be worth by 2030. So yeah, this is not some niche crypto trader toy anymore. It's on track to become a basic, foundational layer of our entire financial system.
So how did we even get here? In this first part, we're going to get into the core idea behind stablecoins. The big problem they were actually created to solve in the first place.
At its heart, the whole concept is incredibly simple. We all know that cryptocurrencies like Bitcoin are just wildly volatile. Well, stablecoins were built to fix that one massive problem. They're digital tokens, sure, but they're pegged one-to-one to a stable asset, usually the good old US dollar. And the goal? It's to give you all the cool benefits of a digital asset without that insane roller coaster of price swings.
And when you put them side by side, the difference is it's night and day. On one side, you have Bitcoin. Let's be honest, it's a speculative asset. Its value can jump up or crash down in a single day, which makes it absolutely terrible for actually buying things. But on the other side, you have a stablecoin like USDC. Its value is firmly anchored to the dollar, making it the perfect digital version of cash, a stable, reliable way to exchange value.
But, and this is a big but, here's where the story gets a lot more interesting and, frankly, a lot more dangerous. That simple idea of a stablecoin, turns out there are very different ways to build one, and some of those ways are just incredibly risky. This led to a huge, dramatic shakeout in the market.
Okay, so there are basically three main flavors. The one that's really dominant is fiat-collateralized. Super simple. For every one digital dollar out there, there's one real dollar or a safe government bond sitting in a bank. Easy. Then you've got crypto-collateralized, which uses a big pile of other crypto assets as its backing. It's a bit more decentralized. And then there was the algorithmic model. This one tried to hold its peg using nothing but clever code and financial incentives, with no real assets backing it up. And as you can probably guess from that little word defunct next to it, that design had a fatal flaw. This is a really crucial part of the story.
Yeah, that algorithmic model wasn't just some theoretical failure in a textbook. It was a real-world catastrophe. Back in May 2022, the algorithmic stablecoin called Terra USD, or UST, didn't just fail. It completely vaporized, wiping out 45 times billion dollars of value in about a week.
And the craziest part is that the collapse wasn't because of a hack or some bug in the code. No, it was something much deeper. The design itself was just fundamentally fragile. See, unlike a coin that's backed by actual dollars you can touch and audit, this one was running entirely on confidence and, hope. And the second that confidence broke, the entire system was basically programmed to self-destruct. So what in the world is a death spiral? Well, it's this absolutely brutal feedback loop. First, something spooks the market, and the coin slips just a little bit below $1. That causes panic, and everyone rushes for the exits at once. To defend the price, the algorithm goes into overdrive, printing insane amounts of its sister token, Luna. But that just floods the market, which crashes the price of Luna, which destroys any last shred of confidence in the entire project. The result? A complete and total collapse. All value gone.
The aftermath of that Terra collapse? It was a massive, industry-wide flight to safety. Everyone learned a very painful, very expensive lesson. And the result today is that the market is just overwhelmingly dominated by those boring, simple, fiat-backed models. Tether and Circle's USDC control almost the entire market. Because, it turns out, when it comes to money, people really prefer the simple, auditable model of cash in the bank over some complex, fragile algorithm. Shocker, right?
Now, that whole Terra disaster could have been the end of the stablecoin story, but it wasn't. In fact, it just cleared out the bad ideas and paved the way for the real revolution, stablecoins moving beyond just crypto trading and into huge, real-world use cases.
This is why we're talking about a $1.5 trillion forecast. Stablecoins are now solving enormous, real-world problems, things like making cross-border payments way faster and cheaper, giving people in countries with crazy inflation a way to save in dollars, and even creating a new kind of programmable money that can automate all sorts of complex financial stuff.
Just look at international payments. The old system we use, SWIFT, is painfully slow and expensive. You could wait up to 5 days and pay $50 for one transfer.
With a stablecoin, that exact same transfer costs less than a penny and is done in seconds. I mean, come on, this isn't just a small improvement. It is a total game changer.
And if you're wondering about actual demand from real people, get this. In emerging markets where the local currencies are super unstable, people are willing to pay almost a 5% premium just to get their hands on US dollar-pegged stablecoins. This isn't speculation. This is a powerful, powerful sign that this product is solving a deep, painful need. For many, it's a financial lifeline.
Okay, so when you have this kind of scale and this kind of real-world utility, it was only a matter of time before the regulators showed up. We are now officially entering a new era of regulation, and what it's doing is legitimizing the industry and setting the whole thing up for truly mainstream adoption. So the world's two biggest economic zones, the US and the EU, are now laying down the law, and it's fascinating to see their different approaches. In the US, a proposed bill is focused pretty narrowly on payment stablecoins, basically trying to pull them into the traditional banking system. Over in Europe, though, their new MiCA regulation is this huge, comprehensive rulebook for all crypto. But even though the details are different, the end result is the same: regulatory clarity. This makes the whole space legitimate, but it also creates really high walls to get in, which probably means the biggest, most regulated financial giants are going to be the ones to dominate this market.
So, this brings us to the big question for a lot of you. How does this massive technological shift actually turn into real investment opportunities? Well, the great news is, with all this regulatory clarity starting to emerge, you can now invest in this whole theme right through the public stock markets.
And there are a few different ways you can play it. You could invest directly in an issuer, like Circle. That's a pure-play bet on the growth of their USDC stablecoin. You could look at a gateway like Coinbase, which gets a nice piece of the revenue from all the USDC on its platform. Then there's the toll road model. Think Visa and Mastercard, who are plugging stablecoins right into their massive payment networks. Or you could go with a fintech giant like PayPal, which is using its 400 million plus users to push its own stablecoin into the mainstream.
And all of this, all of it, brings us to one final, really provocative question. Are we actually watching the slow-motion disruption of the entire banking industry as we know it? Or is this just the next step in its evolution, where the current giants just absorb this powerful new technology to become even more powerful? The answer to that is probably going to define the future of money itself.